Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip reviews some of the troubling news tidbits that point to recession despite the denials from the White House and the Federal Reserve. The housing market is so weak that in some communities, home foreclosures now top home sales. And there's a record pace of stocks with dividend cuts. The 4-week moving average for jobless claims rose to 362,000, above the 350,000 recession warning threshold. Manufacturing is contracting according to ISM readings, and consumer confidence is slumping. My second blip previews this week's economic data to see if the troubling trends persist. Today's release of ISM for February should be below 50, and construction spending is declining. On Wednesday, factory orders should be down 1.5% for January, and non-manufacturing ISM should be below 50 for February. Economic weakness should be reflected in the Beige Book released for the March 18th FOMC meeting. On Friday, non-farm payrolls for February should decline slightly, with the unemployment rate up to 5%. My third blip shows the charts of 4 of the major equity averages I track. Stocks turned on a dime last Thursday when Bernanke told senators that some banks may fail. For the Dow, I show weekly support at 11,889, with daily, annual, and monthly resistances at 12,587, 12,670, and 12,861. Annual support is 10,747, with semi-annual resistance at 13,049. For the NASDAQ, weekly support is 2160, with daily and monthly resistances at 2323 and 2497. A weekly close below the 200-week simple moving average at 2255 would be the first since mid-August 2004. Reflecting the weakening trends for dividends, the Dow Utilities, which set a new all-time high of 555.71 on January 8th, traded to a new year-to-date low on Friday. Weekly support is 465.46, with annual and daily pivots at 483.26 and 486.42, and monthly resistance at 506.48. For the Dow Transports, I show monthly and annual supports at 43.98 and 42.67, with daily and monthly resistances at 46.85 and 48.16. After failing to break out above its 200-day simple moving average on numerous attempts in February, a close below the 50-day at 45.48 would be the next bearish warning. My fourth blip shows the deteriorating daily charts for housing and regional banks. The Residential Housing Index, HGX, a trend below the 50-day simple moving average at 138.04, indicates risk to the year-to-date low at 117.41. Dr. Edward Lazier, chairman of the Council of Economic Advisors, says that home builders should stop building until the supply overhang is worked off. Sounds like more layoffs to me, another recession warning. The 500 members of the American Communities Banking Index, ACBQ, are overexposed to $629 billion in construction and development loans. What happens to these C&D loans if builders stop building? I guess these banks are the candidates for the failures that Fed Chief Ben Bernanke warned about last week. Under the 50-day simple moving average at 229.54 is risk to the year-to-date low at 203.12. Treasury Secretary Hank Paulson described the housing market as a dry forest waiting for a match. I say the forest is already burning. Send your comments and questions to support@rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.